Okay, thanks everyone joining me for this Fuse training on lending and how to increase your business based on lending. It's um, it's kind of second nature to me, and a lot of people get very confused when it comes to lending. I get it. You're in real estate. It's like, look, I buy and sell. I'm an agent. I help people buy and sell. That's what I do. Lending's over there. Go talk to that person. And I have found doing both lending as a loan originator and as a real estate broker for 25 whatever years now. The two go hand in hand. They're so absolutely fused together that you have to know something about one to kind of understand all the components of another. And so understanding a little bit about lending is really key to understanding real estate, at least if you want to maximize your abilities and your knowledge base and how you can facilitate and help your clients. So lending is crucial. It's one of the reasons I started this company. I always want to teach lending at least a basic level so people understand what they're getting into. I think most of you that have been in the industry for a little bit understand, FHA and VA. We do a webinar on those products. This is not going to be that webinar, but you understand the components of FHA, VA appraisals versus conventional appraisals versus conforming loan limits versus FHA loan limits, and so on and so forth. A VA loan is 100% financing. FHA is 96.5% financing with 3.5% down. And conforming, you can get away with as little as 1% down. It's actually a 3% down product, but the lender pays you back 2% of that. And you're going to learn a little bit about why they can do that and what that means. But this webinar specifically is about how to target your clients and let them know that because of your knowledge of lending, because of your ability to facilitate what specifically is going to be a low appraisal, that you are a better qualified candidate to earn their business. That's basically it in a nutshell. Okay, so how do you use finance to give you a competitive edge? It's not complicated, although numbers can seem complicated. You just have to take it pretty slow and just kind of walk through it and understand it and research it a little bit. And hopefully this will help a little bit on it. But obviously, if you have a lower interest rate, you have a lower payment. Also, if you have a lower interest rate, you have the ability to purchase more house. So it gives you more purchase power and it gives you a lower payment. It can do both as well, but it's usually one or the other. And we're going to dive into wholesale rates and show you how that competitive edge, where it is. But effectively, and that's why I've built K loans the way I have, is that we know it has the lowest interest rate in America, period. And one of the only reasons well, actually, it's the primary reason people go to other lenders is because they will pay for half their advertising. So you partner up with some lender, they pay half your advertising, great. You only have to pay half, you both benefit, fine. However, there's money there that has to be used for commissions. And by lowering our commissions and having salary-based loan officers, we can actually lower our rate on the wholesale market. That's what we've done. And it's the most competitive interest rate in America, bar none. You go up against big banks, are typically 3/8 to half a point lower than those big banks, quarter point lower than credit unions. It's amazing how low you can go. But the problem is a lot of people don't want to do that because they're getting business fed to them from whomever the lender is or getting their advertising paid. So I get that. It's just we can't do that. I get that a lot where people they kind of want everything. They want their cake and they want to eat it too. They're like, hey, yeah, we want the lowest interest rate, but we also want you guys to pay for half of our advertising. It's like, well, there's no money to pay for half the advertising because we're lowering the interest rate. We're using that margin at a very slim level. So to me, it's just pretty easy, but I have to explain it a lot to people that they kind of want both, the best of both worlds. But more purchase power and eliminating closing costs for the buyer and the seller. Now, eliminating closing costs for the buyer That's pretty easy. There's two ways for closing costs to be paid for by well, there's three ways: by the buyer, by the seller, or by the lender. Now, typically people don't know about the lender. They know about the buyer and the seller. The buyer typically will come in. It's like, okay, you have $6,000 in closing costs. You pay for that out of pocket. You write a check and done. Then a lot of people say, hey, I don't have the money for that. I want to buy your house. Will you pay for closing costs, Mr. Seller? And the seller says, yeah, I'll do that. This is a full-priced offer. That's fair. Okay, that's in a reasonable market. Sometimes in an unreasonable market, you'll get a buyer that they just can't pay for it. The seller because the seller's being unreasonable. And there's two things they can do there. They can jack up the price, say, let's bring up the price by $6,000, and then we're going to go ahead and credit you $6,000 towards closing costs. So I, as a seller, net the same amount. The other way is to have the lender pay your closing costs. And a lot of people don't realize that. They don't realize that the lender can pay your closing costs. That's effectively what a no-cost loan is the lender paying the closing costs, and there's a price for that. Remember, the price for everything in lending is a higher interest rate. Let that one sink in for a little bit. So a higher interest rate, that's always what is going on with these lenders. Whenever no gimmicks, but the price or the cost or the money is in the margins. I know a lot of people wonder, like, how do lenders make money? How does a loan officer make money? Why does one lender say, hey, I can do this interest rate, but these ones can do this interest rate? It's a buy down. They're paying for that, and you'll see that in these interest rate sheets. But there's always a cost. There's no magic there, but there's always a cost, and almost always that cost, if it's not cash out of your hand, is in an interest rate. And here's something great. It's the interest rate. I heard it the other day with Quicken Loans. They said, we'll do a rate lock guarantee. And then in the fine wording and the fast talking at the end, it's only on select products. Well, guess what? That select product is going to have a much, much higher interest rate than a normal conforming 30-year fix. So they put you in that and say, oh, yeah, we'll rate lock this so that if the interest rate goes down, we'll give you the lower interest rate at what we call par. They'll never go lower than that. But they're going to start at a higher interest rate, hoping that interest rates don't go down, and they probably won't. So you're going to be at a much higher interest rate than you need to be. I'm curious about it. Actually, I'm thinking about giving them a call and applying for a loan with my own credit to see where they are. But my guess is they're very, very high. And that's, again, the cost of everything in this industry and lending industry is the cost to interest rate. So just remember that. You can always ask me or Louie or Sue or anyone on the team if you have a question. Mike has a question right there. Good segue. Let's see. Chat. And again, if you have a question, go ahead and throw it in the chat room and I'll see it as it comes up. Is it legal for the realtor to contribute closing and or pair with the lender to reduce closing costs? It is legal for the real estate agent to credit the borrower for closing costs. So you can say, yeah, I'm going to credit you $5,000 from my commission, and that's going to go ahead and pay for part of your closing costs, maybe all, depending on the cost of the loan. So yes, you can do that. What you can't do is you cannot give them cash. There's so many people that are like, hey, I'm going to give you cash for this. That's where don't give a borrower cash or a client cash. It all has to be on that settlement sheet. It has to wash out on the settlement sheet so it's open and it's right there for everyone to understand. But yes, you can go ahead and contribute that. Well, the lender reducing closing costs, no. The lender is not going to give them a credit to reduce closing costs. Only the real estate agent. That would be a RESPA violation. So don't pair with them to reduce closing costs. Just let the real estate agent can do their commission for closing costs. The lender cannot. I know I probably made that longer than I needed to, but yeah. Yes, Allison, I can do that. Just to let you guys know, Alex is sick today, and let's see. Ta-da! So he usually is kind of shadowing me on these on these webinars, but he's got some flu bug. Marissa's got a flu bug. Angela's not feeling well. It's like, So whenever you run a business, that's part of it, especially this time of year. So thank you, Allison, for getting that to me. Hopefully you guys are all muted right now. Okay, so you're welcome, Mike. Sometimes I drone on. It's the Minnesotan in me. I drone on and I don't even think about where I'm going with it. But stream of consciousness, I guess. We'll call it lending stream of consciousness. So back to what we were talking about. So eliminating the closing costs for the buyer. So as Mike brought up, who can pay for these closing costs? And the real estate agent can. Not that you want to, but sometimes you have to. You get to the end and it's like, look, we didn't realize that it's going to be $2,000 more in closing costs. Sellers being stubborn. It's too late for the lender to change their settlement. And the real estate agent's the last one on the table that can actually just pick up the phone and say, hey, contribute $2,000 of my $10,000 commission because I want to make this thing happen. So it's unfortunately, it is one of those things that we end up doing a lot because there's so many mistakes along the way in this process. And then other people just get stubborn. It's just one of those things where a seller gets stubborn. And I see it more and more and more. And it probably was because it was a seller's market. Now it's changing and changing kind of quickly. So it's changing back to this neutral market. So sellers are going to have to start coming to the table with some cash. They're going to have to start realizing they're only going to get one offer after 30 days or 60 days or 90 days. They're going to have to lower their cost, their price a little bit, and they're going to have to contribute to closing costs. So always remember, as a segue, remember that you never want to infer or let on as a real estate agent that that your client has the money to pay closing costs. You want to play coy in a way. You want to keep it neutral. Hold your cards close to the vest, and any other metaphor you can think of. We want to really make sure that you can maximize what you're getting for your buyer. So asking for closing costs is very reasonable right now, especially on a full price offer. In fact, I would not do a full price offer without asking for closing costs. I'll continue to delve into that since, hey, we're stream of consciousness today, right? So yeah, if you're going to ask for closing costs, or do ask for closing costs, and see what happens. As long as it's a reasonable offer. If it's full price, certainly. If it's a little below full price, sure, that's reasonable. And then the other thing is check with your loan officer. Make sure you understand what the closing costs are. I get a lot of people that say, hey, let's ask for 3% in closing costs. Well, wait a second. What if it's a $400,000 loan? Well, 3% is $12,000. You don't need $12,000 to close that loan. You probably need 7, or 6. And again, compare that to K loans because it'll always be lower with a salary-based loan officer and a fixed fee regardless of the loan amount. So find out what that is. And if you find out it's $6,000, then hey, you can ask for 1.5% in closing costs. And then the seller's more apt to go, yeah, you know what, I'll do that. It's a full price offer. That sounds pretty good. So we're going to get back into a world of fewer multiple offers and asking for closing costs and asking the seller to be reasonable and so on and so forth. It's right there. It's right around the corner. But yeah, how do you eliminate the closing costs for the buyer and the seller? Again, you can have the seller pay it, but that doesn't help them very much. And the buyer can pay it out of their pocket, but that doesn't help them very much. It's the lender that can pay the closing costs. So we'll dive right into that now because you guys are sick of listening to me and I'm sick of listening to me. And I got lawn work going on outside the office, so I apologize. Okay. So here is a wholesale company that we work with a lot, United Wholesale Mortgage out of Michigan. So these guys are pretty good. They do very, very good underwriting, very efficient. We really like working with them, and their pricing is also exceptional. Not the best in the industry, but exceptional. So sometimes there's a balance between like getting the deal done and getting the best interest rate. So what we do is we price a loan. So when we price a loan, we can just go to rates. Let's take a look at a rate sheet today. And again, I do this in a lot of webinars because it's important to understand what rate sheets look like. It's important to understand what your loan officer is seeing that you can't see. It's important to know what happens behind the scenes and how we price loans. So this is something kind of special to see. Somewhere in something, I'm not supposed to show this to you, but whatever. So the more you know, the better you are. So that's why I like to show it. And this, like the stock market, is changing every day. If you look at it up top here, you'll see that price change effective at 9 a.m. Eastern today. So at an hour from now, this could all change. And so it's going up and down, back and forth, and it just kind of spikes. And it depends on where the market goes. So as the stock market goes up and down, these interest rates will go up and down. And when there's absolute crazy volatility, they'll shut it down because they don't know exactly where it's going or it's moving too fast. So occasionally we get that where rates are locked, they're shut down, and they'll get back to us in 4 hours when things settle down. So that does happen occasionally. So here's elite pricing right here. This is a 30-year fixed loan. These are the interest rates down this column, and then 15, 30, and 45-day locks. And then you can see we can do 16 to 20 years, we can do 11 to 15 years, or 8 to 10 years. So if someone says, hey, Joe, I want a 19-year fixed loan, we can do that. So it would be in this column right here, the second one, elite, 16 to 20 year, and the pricing would be in this box. So there's a lot of flexibility, whereas a few years ago, I was like, hey, you got a 15-year note or you got a 30-year note. Now you can get a 13-year note. And so we do want to let people know that, because the faster they can pay it off, the better. And the smaller the loan time, the amortization, the lower the interest rate. So paying a bank interest over time is enormous. And so you don't want to do that if you don't have to. So we'll stick with a 30-year fixed. And so just to kind of go over how pricing works, we go down the column until we get to the lowest negative price, which today is all the way at the bottom, 4.375 on a 30-day lock. That's actually a credit. I know it shows as a negative number, but that's actually a credit. So, but it's almost zero. And zero on this chart is called par. So we always try to get as close to par as we can. So if someone said to me, hey, Joe, I've got really good credit, I got 20% down, and I'd like the best interest rate on a 30-year fixed for my conventional loan, a $400,000 loan on a $500,000 purchase, then I would say, you know what, you get 4.375% today. And down here is the elite program, some of the things that they have to have. So nothing too crazy, 700 plus credit score, 80% or less LTV, meaning 20% down or more, or equity in the house if they're doing a refinance, and then loan amounts more than $200,000. So not too difficult to get to. And that's a pretty awesome rate, 4.375. Right now we have a volatile stock market. So the stock market's kind of been all over the place the last few weeks, so interest rates have come down. When the stock market is crazy, people pump money into the bond market, and that's what mortgage rates are tied to, 10-year Treasury note, and specifically the 10-year Treasury yield. So when the stock market's crazy, they get scared, they panic, they put institutional money into the 10-year Treasury, and that 10-year Treasury, the more money it gets into it, the lower the interest rates go. So that's kind of what's happening right now. I anticipate the stock market still being a little bit crazy over the next few months because of trade wars, because of GM's laying off some people, because it's just a lot of mixed signals out there. So one day it's way up, one day it's way down, one day it's way up, and so on and so forth. So a lot of volatility out there, and as big institutional investors panic, the ones that handle billions of dollars, they panic. They take that money and they move it every day. And a lot of times they just move it to the 10-year Treasury note, which is the most stable place to park your money on the planet. So, and that's why interest rates have come down. So 4.375 is fantastic. Shout it from the rooftops. Get up in the towers and tell everybody, hey, it's 4.375 for a 30-year fixed loan. Then if you go over here to, let's say, a 10-year fixed, well, par is way down here at 3.625. A 15-year note, 3.75, and a 20-year note is about 4.125. And I say about because here's a little bit about lending that you guys need to know. So people talk about a buy down. Hey, I'm going to pay points for that interest rate. Sure, you're going to pay points. Well, who determines the points? What are the points? Where do we find the points? Right here in this column. So at 4.125% interest rate, this person's going to pay 0.336 to get that interest rate. Okay, does that make sense? Actually, let me check to see if there are any questions on that. Bum, bum, bum. Nope, none. Okay, so I'll say that again. So they're going to pay to get 4.125%. Now, 0.336 is not a lot of money. So let's say we do a $300,000 loan. 0.336% is $1,008. So pay $1,008 to have a better interest rate for 20 years is probably a pretty good idea. If they're going to stay in the house for 3 or 4 years, I'd say no, don't do this. In that case, go with 4.25%, and guess what? You get that as a credit. Okay, so that's the credit you're going to get. We'll do the numbers on our $300,000 loan. 0.532% is $1,596. So you're getting $1,596 towards your closing costs for this. So this is the magic of lending, and this is how you can help buyers and sellers, because the seller might be too stubborn to get out of their own way and say, I'm not going to pay for closing costs and I'll kill the deal. Well, okay, let's not kill the deal. Let's get closing costs paid for by the lender. And so we go back over here to a 30-year fixed, a $300,000 loan. Let's say they need 2 points. They need $6,000. Well, how do I find 2 points that the lender will pay to pay for closing costs? There it is right there, 1.914 at an interest rate of 4.75%. Now that 4.75% is the same interest rate over across the street at Bank of America or Wells Fargo or Quicken Loans. So that's what they're starting with, and they're not paying for closing costs. You come here to K Loans, this is what we put you into, and all of a sudden you've got $6,000 for closing costs, you've got a 4.75% interest rate, and everybody's happy. So that's the idea. If you just go with the lowest interest rate, you've got a lower payment, okay, at 4.375. If you do a 4.75% interest rate, you've got closing costs paid for by the lender. So now the seller's happy. The seller's like, oh, fantastic. I don't have to pay closing costs. I'll accept your offer. So this is why the power of lending can really help you as you're doing real estate, as you're negotiating those closing costs, as you're negotiating price, as you're negotiating all these different angles on that transaction. Understanding and starting with lending is really the best way to go, because the closing costs can be much lower, and or none of those parties, the buyer or seller, have to pay the closing costs. The lender will. Okay, questions? Ann T. I got cotton mouth. And for those of you in Idaho, no, we don't smoke pot here in Washington. At least not everybody. So it does seem like it's everywhere, but no, I'm too old for that. Okay, so hopefully you guys understand that. Technically it's called yield spread premium, but you also hear it as a rebate. And there's a lot of money here that a borrower can get. Now, if they go higher, because I get this question a lot from different borrowers and buyers, is, okay, what if I go for even a higher interest rate and I get 2.875 back? Well, do I get that money? I only need $6,000. Do I get an extra couple $1,000 or $1,500 back to me as cash? No. None of this money can go to you as cash. It can go to the borrower as cash. It does not go as cash. It's simply left on the table, and the lender gets that money. So they're not using it for closing costs. So we want to dial this in, and that's one of the keys to really going, okay, Mr. Buyer, what are you buying? What's your price range? And then look at exactly what those closing costs are going to be. And that's usually where they are. About 2 points on a $300,000 loan. That's about $6,000. It does depend, if they're charging a higher origination fee, it's going to be higher. If it closes in a certain month during the year, they're going to have to come in with more in taxes and insurance. So it just depends on the month it closes, and so on and so forth. But before you ask for closing costs, make sure you understand exactly what those closing costs are going to be from the loan officer. Okay, let's see where we are. This is going to be a quick one. I love it. Okay, dealing with low appraisal. So I'll run through that pretty quickly. Now, this is one where if you have the understanding of how to deal with a low appraisal, you can really, really do well in some of these transactions. So we're still seeing it in hot markets. And it depends on the price point too. So even in Seattle, which was a white hot expensive market, higher price points are not moving, but certainly a $500,000 house is going to move instantly with multiple offers and probably escalations. So it depends on the price point, and it's probably pretty hot in your market as well at that lower tiered price point. And I say lower tiered because it's not really the bottom of the barrel. It's not the junk stuff that people are paying cash for to flip and do all that. It's the stuff right above that. It's that second home, that lower end of the second home spectrum where it's very competitive. You have, let's say, for example, a young couple. They both have decent jobs now. They started off in a crappy little house, but now they want to buy that house that's just a little bit better. That's a really competitive market depending on where you are. And that typically is going to generate multiple offers if it's priced right. Now, the problem with that is that, okay, the appraisers are going back 6 months looking at comps for their appraisal, but you've got multiple offers and everyone's willing to escalate that price up. Well, the appraisal is going to hold that price back. Everyone's willing to pay $300,000, let's say, for this house, but the appraisal is going to show $280,000. Okay? So you're willing to pay the escalation. Everyone's on board. They're happy with that, but the appraisal came in low. And now you've got a conundrum. What do we do? Everyone's nervous. Nobody wants to kill the deal, but who's going to pay this $20,000 difference? Now, typically, the first place to go is the seller and say, hey, Mr. Seller, you've got to come down in price. And so a lot of sellers are going to be like, no, I'm not going to do that. It's a hot market. I'll put it back on the market. When they say that, now understand when they say that, in the back of their mind, they're going, am I making a mistake? There's a lot of people out there that are so ultra confident in what they're doing, and it's pretty phony. And I usually see through it pretty quickly. It's a lot of phony confidence because it's like, what are you doing? You're being foolish to walk away from a good deal. We have a problem. Now let's solve it. So, but ask them. Ask the seller, hey, do you want to come down to 280? Sometimes they split it. Sometimes the seller will come down $10,000, and the buyer's got to come in with $10,000 more cash. Or in a lot of cases, the buyer will just come in and make up the difference with cash. In Seattle, we see that a lot. Not as much this year as last year, but last year there were a lot of offers saying, hey, in case of low appraisal, I'll come in with $20,000, up to $20,000 to make up the difference in cash. Okay, great. That person's got a lot of cash. So what happens when they don't have a lot of cash? What happens if they're just going, okay, I've got a $20,000 deficiency. The seller's not going to come down in price. They're just going to put it back on the market. And I've got to figure out how to come up with $20,000 on my $300,000 loan. Okay, what are you going to do? And a lot of people just don't realize this. So again, I'm going to kind of go slow about this. It's one simple concept, and that is that they need to put less money down. Okay, so a lot of people go, I'm putting 20% down, I've saved it, or it's coming from my other house that I'm selling, 20% down, I don't want to pay mortgage insurance. And this is the key. They don't have to pay mortgage insurance. So too many people think, hey, if I don't put 20% down, I've got to pay mortgage insurance. That is not the case anymore. You never have to pay mortgage insurance. So now, again, what I touched base on at the start of this webinar, there's always a cost to that. The cost to that is going to be a little bit higher interest rate. But when you start with a much, much lower interest rate, going up a little bit still puts you at an advantage. So, okay, hopefully that makes sense. So now where do we find the money? Let's take a look. So instead of putting 20% down, which for 300,000 is $60,000, okay, they've got to come up with $30,000. So what I tell them is go, okay, only put 10% down. You've got $30,000 cash you can give to the seller to make up for the difference because you really want this house, and it's probably worth the 300. Just because the appraisal says 280 doesn't mean it's not worth 300. It's worth what the market will bear. But in that case, we can't do this elite pricing because we're not doing 20% down, and now we're going to have to figure out mortgage insurance. So now we just go to regular conventional financing right here on this chart. Interest rate's a little bit higher, so par instead of being 4.375 is 4.5%. Okay? Now we've got to buy out the mortgage insurance. So we're going to figure out what the cost of that mortgage insurance is, and I'm going to do that by doing pricing, easy qualifier. So let's go in here. So let's say they've got their 700 credit score. Put Louis' name in there. Example will be the name of the borrower. And they're doing a loan amount of $300,000. Sales price, oh crap, loan amount of 270. I can type. And then a sales price of $300,000. An appraised value of $300,000. Okay, so we're at 90% loan to value. There's the 10% down. For a purchase, is primary residence, single family residence, 1 unit. We can do, let's do the state of Idaho. And county will be Ada. Okay, and 700 credit score, compensation, borrower paid, 30-day lock. Now here's the key right here. So this is where we eliminate the mortgage insurance. Lender paid mortgage insurance. We can do borrower paid mortgage insurance, BPMI, but in this case we want the lender to pay the mortgage insurance. And let's see what the interest rate is. Okay, a Home Possible product. Let's see more rates. And there it is, right there. So 4.5% is only 10% down, and the lender is paying the mortgage insurance. You see this MI right here? That says 0. And they get 4.5% interest rate, a payment of $1,368. So there's the magic. That is the key to this, is that you don't have to put 20% down. You can put less down and not pay mortgage insurance and still have a better interest rate than the big banks. So there's people that walk in blindly to the big banks and go, hey, yeah, I want a 30-year fixed. And the loan officer says, great, super friendly. They got coffee and cookies in the corner. Everyone's very happy. And they go, your interest rate is going to be 4.75%. Well, and that's with 20% down. That's what's, it's great credit, 20% down and all that. So we can actually do better than the banks and eliminate closing costs and have only 10% down. And we can get even crazier. So this pricing tool is pretty cool. If I do, let's say, 95% loan to value, okay, 285 loan. If we do that, let's see what we get. We get par, still 4.5%. Okay, so even with 5% down, they can get 4.5% interest rate. And so that's the money, using that money, that what they were going to put 20% down, now they can put that towards the low appraisal and still keep the same purchase price and get the house they want. Mindy, sorry about the audio. Don't know what to do about that, but this is being recorded and I'm going to upload it onto our YouTube channel, and that should be in about an hour or two. It should be on our YouTube channel. Just go to YouTube, type in Kelly Wright Real Estate, and you'll be able to find the different Fuse trainings in there. So it's all recorded, and it should be okay. But anyway, does that make sense? You guys understand this? Again, ask any questions if you have them. But this is the power of lending right here. It's going, hey, you're only putting 5% down, and you're still getting a 5 or 4.5% interest rate, and there's no mortgage insurance involved. That, my friends, is the best deal in real estate and lending in America. Bar none. I don't care what anyone else says. I price this thing on the wholesale market to have these kind of numbers pop up. Now, I could price it differently. And what that means on the wholesale market is once a year we go in and we say, we want these margins. So Quicken Loans and Bank of America, they want huge margins. And we want just teeny little margins on the secondary market so that we keep our rates really, really competitive. And what that means, that margin is what they're selling on the secondary market. So that Bank of America and Quicken Loans makes, I think on average, last time I read, was $16,000 on every loan. So if you guys ever wonder where the big, big money is in lending, that's it. It's not on the local corner office with your $40 deposit. It is about Bank of America pooling their loans in the middle of the night and selling them on the secondary market and making these huge profits on those margins and getting all that money back in their coffers plus some. So that's how big lending works. A lot of people ask, is it sustainable? Absolutely not. This is why, well, sometimes I wake up in a cold sweat for a variety of reasons. But this is one of them that, someday down the road, 20 years from now, that Fannie Mae, Freddie Mac, FHA is all going to collapse. That secondary market will no longer exist, which means lenders would have to do what they used to do 100 years ago and go, oh, I've got $2 million in deposits. I can now lend $2 million. And that's not how the system works today. So, but that's where the big money is made, and that's why our pricing is so good at K-Loans. So I encourage you to compare and get your clients to compare K-Loans to any lender in America, and then again, they can have a little bit lower payment, or get their closing costs paid for by the lender, or they can get in a situation where the appraisal comes in low, they can use that leverage, that lending leverage on the wholesale market to come up with cash. So the seller should be happy because the seller's getting their actual asking price, and the buyer should be happy because the cash they've saved or are going to use, they can use to make up the difference in price and still get a better interest rate and not pay closing costs or mortgage insurance. When I say closing costs, that just means we'd have to raise the interest rate up a little bit, get up to 5%, and then there's more money for the closing costs. Okay, I know it's a little bit complicated, but it is lending. Let's see. Okay, no other questions. Mindy had that question, so all right. Let's go to our final part of this. How to specifically use this to sell yourself and win business. Keep it simple. I mean, I know I'm all over the place, and again, it's our stream of consciousness day today, and you don't want to be all over the place when you're selling this to your clients. What you want to say is that our company uses the power of lending to eliminate closing costs or provide a lower interest rate if needed to help offset a low appraisal if that scenario should come up. So we have more tools in our tool belt to help make this transaction work. And Alex and I are going to work on something where we've got an insert in our folders. We're halfway finished right now that kind of explains that, so you can give that to your clients. Ultimately, they're buying you. They're buying your expertise. They're buying the relationship. They're buying your ability to market the property. They're buying all of that. But this might give you a little bit of a competitive edge. And also, just regardless of how you start the transaction, if you do get to that situation where you have a low appraisal or you have to make an offer that escalates, let me know. Give me a call. I love doing this. I love putting the pieces together because there's a way to make it work without everyone going bonkers and trying to kill the transaction. And it's usually the answer is in finance. Now, again, whether it's closing costs or whether it's just a lower interest rate or whether it is using cash on hand for the difference between the agreed upon price and the appraised price. So, and still coming out clean on top, still coming out without paying mortgage insurance. So there's real advantages to lending when you are selling real estate. So just understand it the best you can. And of course, you can always ask me specific questions as we go along. You can email me, text me, or call me. Let's see. Oh, professionalism. Yeah, I remember this. I added this a couple rounds ago. Just because it was getting pretty heated in the summertime and in the springtime, I was getting calls. They've died down now. So hopefully everyone's used a little bit of that advice, and not just in our company, in all companies, to say, okay, look, we're not going to accomplish what we want to do here, and that's a successful closing, if we're all screaming at each other, if we're being unprofessional. So real estate agents need to, more than anyone, be professional and really make sure that they are communicating well with their client and communicating well with the other agent. And remember, it's a team effort to get this thing going. And a lot of things happen in transactions. If you've been in this long enough, which I know some of you have, if you've been in this, you've seen crazy stuff happen. You've seen last second situations where people walk away from the closing table. You've seen them maybe buy a big, huge new pickup truck 2 days before closing, not thinking that they're going to pull the credit right before it funds. All that stuff can happen. It's like, oh my gosh, what do we do? Maybe after the inspection, all of a sudden there's a freeze and pipes burst. You know, it's like, oh my God, what do we do? Who makes the claim? How do we extend? How fast are we going to get this thing fixed? Does the buyer still want to buy? Are they going to try to get out? And all these things happen. If you panic and you get crazy, you'll make your client crazy. So don't panic. Just say, okay, there's a solution to this. Let's sit down as adults and figure out what is the solution and what do we do to get this thing to the closing line, finish line, closing, whatever. But you guys get that. So a lot of shouting and screaming earlier in the year. That's died down now. So people, I think, are getting more reasonable. Don't your clients get stressed out. They're the ones that really are like, oh my God, what are we going to do? I'm angry, I'm mad, I'm sad, I'm crying, I'm yelling. And we have to just kind of listen, let them vent, and then go back to this even-keeled professionalism that allows us to get these transactions done. And I bring that up in this segment because it is that low appraisal that freaks people out. They're like, oh my God. And then, the buyer's like, I'm not going to pay that. It's only worth 280. You want 300. Well, what are the choices? You got A and B. Walk away or get the deal done. So when they're presented that, they're like, well, I don't want to walk away. All right, well, let's get the deal done. And I cannot tell you how many times, you guys, that I see people that say, okay, you have two choices. You can walk away or get this done. And they go, well, I don't want to walk away. I say, okay, let's get this done. They're like, well, no, I don't want to get it done like that. I'm like, okay, then let's walk away. And no, I don't want to walk away. I mean, it's just this childish circular argument that doesn't realize, okay, something's got to give. And then ultimately it sinks in and they come to the grown-up world. But it's amazing how many people are just like, there's two doors to choose and they want door number 3. Price is Right, I think. I don't know. I haven't seen a game show in decades. But anyway, it's really, really important that we help guide them through this process. And the more you know, the better you are. And the more you know about lending, the better professional you're going to be. So keep learning, not just from me and this webinar and all the other stuff we teach here at Kelly Wright, but from all the study you do out there. And you can Google stuff, you can YouTube stuff, you can, there's all sorts of different people explaining lending. Read as much as you can, understand the marketplace, and the more you know about lending, the easier your real estate transactions will be. Okay, Kelly Wright Professionals, I am finished. I am exhausted. It's only like 11 a.m. here in the Pacific Northwest, but I'm going to go get some fresh tea, splash my face, and continue on with the day. This will be on our YouTube channel here in a couple hours. And I'm going to go see what I need to do to keep Alex's offices moving and all the other sick people around here. So it is crazy busy. There's a lot of people out and sick right now. If you need me today, just please be patient. I'm doing my best to get to everything I can, but it's just one of those kind of days. So, but lending is fantastic. It's a good way to make real estate happen. And thank you for watching this webinar. All right, everyone. Goodbye. We'll stop the recording.